Welcome to the Deep Dive. Today we're tackling a really critical evaluation of a stock that's been, well, everywhere. Supermicrocomputer, SMCI.
Hard to miss that one.
Right. We've got quite a bit of analysis here, mostly from Seeking Alpha contributors writing in May 2025, and a lot of it is leaning towards a sell rating. We'll look at wider analyst views too.
Okay.
So our mission today is really to, cut through the noise, understand the core arguments behind this bearish view, but also, importantly, acknowledge the other side, the counter-arguments. It's a really fast-moving space, this AI infrastructure market.
Absolutely. SMCI has been a huge beneficiary of the AI boom, no doubt. But yeah, the recent performance, future prospects, they're definitely under the microscope now.
Okay, so let's jump right in. First big piece of this sell case comes from Mark Gerstein, published May 21st, 2025. He seems persistently concerned about past accounting issues.
Right, that keeps coming up, even though the delayed 10K got filed, new auditor.
Yeah, he still flags the internal control improvements as a, quote, work in progress. It feels like that history is casting a bit of a shadow for him.
Well, it's a fair point, isn't it? I mean, the market loves future growth stories, but you can't completely ignore those foundational things. They represent a potential risk, maybe to investor confidence later on.
He's also skeptical about let's say, the pace and size of the upturn from NVIDIA's Blackwell transition. He points to fierce competition, suggesting maybe the market's getting a bit ahead of itself, expecting a huge boom right away.
Yeah, and that's interesting because the competitive dynamic seems to be shifting. SMCI definitely had, an edge with the Hopper generation. But Blackwell, it feels like a much more crowded field now. You've got the established players stepping up, and crucially, the ODMs, the original design manufacturers.
Yes, Gerstein really hammers on those ODMs. Companies like Quanta, Willin, Inventec, Foxconn, he calls them price killers.
Yeah.
He argues they're moving in on SMCI's territory, even where SMCI was early, like rack scale solutions and direct liquid cooling, DLC. He even draws parallels to, like, Xerox or BlackBerry companies that were first movers but lost their edge.
That's a powerful analogy.
So the key takeaway seems to be that early lead SMCI had, maybe not a fortress, and these ODMs can really squeeze margins.
Exactly. First mover advantage is great, but it's often temporary, right? Unless you keep innovating, building those defensible moats. Gerstein's point highlights that risk of commoditization, especially if ODMs get good at this stuff too.
And speaking of margins, Gerstein notes they'd already started narrowing before Blackwell really hit. Makes you wonder what the new normal for SMCI's profit looks like.
It does. Were those peak margins just, an anomaly from the initial AI surge? Can they keep that up? If the ODMs really apply pressure, further margin contraction seems, well, pretty likely.
Okay, now, SMCI's Data Center Building Blocks Initiative, DCBBS. Management pitches it as a move to more integrated solutions. Gerstein sees it a bit differently. More like a defensive play, actually. A way to compete with the low-cost ODMs by adding services, rather than something totally new. He even references the CFO, David Weingart, back in September 2024, suggesting their vertical integration was already kind of a systems offering.
Okay, so Gerstein's framing it as maybe less of a revolution and more of an evolution, or even just strategic repackaging to fight off the ODM threat.
Pretty much. Is it a real step up or just enhancing what they already do? The jury seems out, according to him.
And whether customers see enough added value to pay potentially more than they would for an ODM solution, that'll be key.
Right. And finally, from Gerstein, there's this pressure of just constantly having to beat expectations. He mentions the Keynesian beauty contest.
Yes. Investing based on what you think other investors think.
Exactly. For a stock like SMCI, any miss on guidance, any hesitation could trigger a negative reaction, regardless of the long-term story.
That's such a critical point in today's market for these kinds of stocks. Sentiment is a huge driver, short-term especially. If SMCI doesn't meet those really high expectations built around AI, you could definitely see the stock take a hit.
So yeah, pretty thorough bearish case from Gerstein. Now let's shift to Bears of Wall Street, published just a few days later, May 27th. Their sell rating also flags some major concerns, especially around the Q3 FY25 earnings. They called it fairly weak.
Yeah, they really zoomed in on those recent numbers. That $4.6 billion in net sales, it missed their forecast and was down, 19% from the previous quarter? That's a significant drop.
It is. And not just revenue. They point to the non-GAAP EPS, earnings per share, only year-over-year down quarter-over-quarter. For them, it's a clear sign growth is faltering.
And they tie the revenue miss, like Gerstein hinted, to customers hitting pause, delaying commitments while they figure out Hopper versus Blackwell.
Right, so there's agreement on that transition causing friction. But bears of Wall Street seem maybe more worried about how deep and long this slowdown might be.
It seems that way. And they bring up inventory as a major worry. Specifically, the H100 systems SMCI might still be holding on to.
Yeah, the risk that stuff becomes obsolete as Blackwell ramps up could mean more write-downs like the one they took in Q3.
That's a classic tech transition risk, isn't it? Stranded inventory. If they can't sell that older gear profitably, it hits the bottom line. Simple as that.
They also echo the margin concerns. Gross margin down to 9.7% in Q3 from 11.9% in Q2. They blame aggressive discounting on the older platforms.
So sacrificing margin to clear out old inventory, again, reinforces that pressure from the transition and competition.
Another red flag for them, customer concentration. 2 big clients making up 36% of revenue in Q3. That's actually down from 57%.
Which might sound good, but 36% from 2 customers is still really high.
It is. And they mentioned past reports of big clients shifting some orders to competitors like Dell and HPE, raising the question, will all that share come back?
That's the risk with high concentration. Losing one big fish makes a huge difference. And if there's history there, it makes you wonder about customer loyalty or maybe just the competitive pressures.
And finally, they're really skeptical about SMCI sticking to its $40 billion revenue target for FY26.
Yeah, given they kept cutting the FY25 forecast, now down to $22.6 billion range, that $40 billion looks like a huge jump.
A very big jump. And they think the stock's overvalued. They ran a DCF, a discounted cash flow model.
Always interesting to see those. What do they come up with?
An intrinsic value of about $25.47 per share.
Mm-hmm.
At the time, the stock was around $41.65, so significantly lower.
Wow. Okay. That's a pretty stark valuation call. Depends on their assumptions. Of course, they use a 3% perpetual growth, 8.21% WACC. Seems conservative, but maybe realistic given the headwinds they're highlighting.
So, okay, we've heard 2 pretty strong arguments for selling or being cautious. But there's always another side, right? What about the bull case, the potential upsides?
Absolutely. You can't ignore the bull case. It really centers on that pent-up demand for Blackwell GPUs. The idea is once the supply chains sort themselves out, SMCI, with what bulls see as a first-to-market advantage.
Right. They're shipping high-end Blackwell systems, taking orders for more.
Exactly. They should see a big surge in orders and revenue. That's the core hope.
And that massive data vault deal, the $20 billion partnership for GPU platforms in Saudi Arabia and the U.S., that seems like a pretty solid data point for the bulls.
For sure. It's not just the huge number, though that helps. It signals SMCI can land these massive, potentially custom deals. It gives some revenue visibility, too.
What about their own initiatives, like DCBBS? Even if Gerstein saw it defensively, offering complete package servers, storage, networking, cooling, software, services, promising faster deployment, lower cost, that could genuinely appeal to customers, couldn't it?
It absolutely could, especially as complexity grows. And their focus on direct liquid cooling, DLC2, that's increasingly important. Power and cooling are huge challenges in AI data centers. Expertise there is a real potential edge.
And management, despite the rough Q3, is sticking to their guns about long-term growth. They blamed the EPS hit mainly on that one-time inventory write-down.
Right. The narrative they're pushing is this is temporary pain during the transition, the underlying AI opportunity is massive, and we're positioned to capture it long term.
Even on valuation, before the Q3 numbers really sank in, Gerstein himself noted the forward PE and PEG ratios look okay, maybe even attractive for a high-growth AI play.
Though that was before Q3 results cast doubt on those forward earnings estimates. The bull case on valuation relies heavily on SMCI delivering that high growth going forward. Q3 definitely muddied the waters there.
And it's just worth noting the sheer spread of opinions on Wall Street right now. Post-Q3, you've got everything from strong buys to sells, price targets all over the place. Goldman Sachs at $24, Needham at $39, Rosenblatt lowered to $50. It's wild.
It really is. That lack of consensus just screams uncertainty, doesn't it? It highlights how tough it is to call SMCI's near-term path. Market beat consensus seems to be a hold, average target mid-$40 back in late May.
So recapping those recent numbers, Q3 FY25 revenue, $4.6 billion, down 19% quarter-on-quarter. Non-GAAP EPS, $0.31, down sharply. Gross margin squeezed to 9.7%. That's the tough picture.
Yep. And the revised FY25 guidance reflects that pain.
But then you contrast that with the $20 billion data vault deal, the push on Blackwell systems, the DCBBS launch, the DLC tech.
Right. And the stock price reflects that tension. The volatility in 2025, the big run-up, the drop after earnings, the partial recovery on the data vault news. The market is clearly wrestling with all this.
Yep. So it really comes down to weighing the short-term pain against potential long-term gain, which brings us squarely to the risks. Let's just summarize them clearly.
Okay.
Intense competition, especially from those ODMs, the price killers. Risk of continued, maybe sustained margin pressure. Execution risk, can they manage this Blackwell transition smoothly?
Yeah.
Handle that big inventory number, nearly $3.9 billion?
It's a lot of inventory.
Customer concentration, still high at 36% from 2 clients. The shadow of past internal control issues, even if resolved. And just the fundamental question, can they sustain hypergrowth? Plus, the pressure cooker of the guidance game in AI.
It's a long list. And they're interconnected, right? Competition hits margins, which makes hitting growth targets harder, which puts more pressure on guidance. It's a tricky web.
Finally, valuation again. Late May numbers. Forward PE for FY25, around 19-20 times. Forward PEG, maybe 0.67 if you buy the optimistic growth. Forward EV sales just over 1. How does that stack up?
Well, compared to some tech hardware averages Gerstein cited, the PE looks a bit high. The PEG looks good if the growth materializes. But then you have that $25 DCF from Bears of Wall Street staring you in the face.
So it's the core debate. Is SMCI a premium AI leader deserving that valuation, or do the current headwinds mean it should be valued more like, well, a hardware company facing tough competition?
That's the multi-billion-dollar question, isn't it? Your conviction in their ability to navigate these challenges and really capitalize long-term on AI, that's what the valuation hinges on.
Okay, so let's try to wrap this up. This deep dive into the sell arguments for SMCI. It definitely paints a complex picture. You've got this company with huge long-term AI potential, no doubt about it.
Right, plugs right into a massive secular trend.
But it's hitting some very real turbulence right now. The product transition, serious competition heating up, and clear pressure on margins showing up in the numbers.
Yeah, the sell arguments aren't just theoretical. They point to actual financial underperformance recently and structural competitive risks that seem pretty concrete.
Exactly. And this leads us to a final thought, something for you, the listener, to chew on. Given how insanely fast AI infrastructure is changing, the innovation, the shifting players, how do you, as an investor, weigh these short-term bumps and bruises against those undeniable long-term trends when you're looking at a company like Supermicro?
Is this current air pocket, as some call it, just a temporary dip you buy into? Or is it maybe signaling something more fundamental changing about SMCI's growth path, its profitability, its place in the ecosystem? That's the crucial question right now.